Three events converged in the last 48 hours that validate every warning I've issued on this platform. A fourth development sits buried beneath headlines, ignored by financial media operating under editorial pressure to maintain market confidence. When you reach the end of this transmission, the mechanics behind gold's rebound to $5,000 and silver's recovery to $78 will crystallize into perfect clarity. More importantly, you'll understand why the next phase could dwarf everything we've witnessed so far. The United States government just ratified a price floor mechanism for critical minerals. Silver sits at the center of that list. Hecla Mining, North America's dominant silver producer, published their annual financial statement. Concealed within the accounting disclosures is irrefutable proof that industrial purchasers are circumventing commodity exchanges entirely, paying 30% premiums to secure metal directly from extraction sites. The chief executive of APMEX, America's largest online precious metals distributor, released a public letter confirming shipping schedules have normalized after 4 consecutive weeks of operational paralysis. And right now, 35,000 call options on March COMEX silver futures remain in the money despite a 46% price annihilation designed specifically to destroy them. These 4 data points, arriving in a single 24-hour window, construct the most bullish technical formation I've documented since this cycle initiated. I'll be direct with you. When I watched these 4 stories surface simultaneously, the timing seemed almost mathematically improbable. Let's begin with the structural game changer, because this rewrites the entire playing field. Bloomberg published confirmation yesterday that the United States has engineered a critical minerals price floor system and is currently negotiating implementation terms with allied governments. This is not speculation floating through alternative media channels. This is not rumors circulating on message boards. Under Secretary of State for Economic Affairs Jacob Hellberg confirmed on the record that multiple federal agencies have constructed this framework and are conducting active diplomatic conversations with partner nations to establish enforcement protocols. But this announcement didn't materialize from a vacuum. Let me walk you through the complete timeline because mainstream financial press is covering yesterday's headline while deliberately omitting the foundation that makes this development inevitable. On February 4th, Vice President J.D. Vance addressed representatives from 55 sovereign nations at the Critical Minerals Ministerial hosted by the State Department. He delivered a statement that should have dominated every financial publication's front page. He declared the United States will establish reference prices for critical minerals at every extraction and processing stage. For nations participating in the preferential economic zone, these reference prices will function as a floor, maintained through adjustable tariff mechanisms to preserve pricing integrity. Let me translate that bureaucratic language into operational reality. The United States government is announcing to the global economic system that critical minerals, a category that explicitly includes silver, will operate under a minimum price threshold, a floor beneath which market pricing cannot descend within the trading bloc. And they're enforcing compliance through tariff architecture. This is not a policy suggestion open for debate. The European Union has committed to participation. Japan has signed implementation agreements. Mexico has joined the framework. 11 countries executed bilateral accords on the same day. Simultaneously, the administration unveiled Project Vault, a $12 billion critical minerals reserve capitalized through $10 billion from the United States Export-Import Bank and $2 billion in private sector commitments, designed to stockpile strategic materials and stabilize price volatility. When I first processed this information, I read the policy documents 3 separate times because the implications cascade through every level of the precious metals market. A price floor means the United States government is explicitly stating we will not permit market forces to value silver below a predetermined threshold. That's not free market capitalism operating through supply and demand equilibrium. That's strategic economic warfare prosecuted through price controls. And the fact that 55 nations are sitting at the negotiating table signals this extends far beyond domestic policy adjustments. Think carefully about what this policy shift means for physical silver. The United States government has now officially acknowledged that the free market pricing mechanism for critical minerals has been compromised. That China's monopolistic control over processing and refining infrastructure has distorted global prices to levels where Western production cannot achieve economic viability. And their solution is not to allow competitive market dynamics to restore balance. Their solution is to impose a government-mandated price floor backed by tariff enforcement. This represents the most structurally bullish policy framework for silver implemented in modern financial history. I'm not using hyperbole for dramatic effect. If silver operates under a government-guaranteed price floor, every ounce in your possession carries an institutional backstop. The government is broadcasting to global markets that your silver holdings will never decline below a specified value within this economic alliance. That transforms the entire risk calculation for mining operations, industrial procurement strategies, and anyone holding physical metal outside the banking system. And here's the detail that makes this announcement particularly revealing. This policy framework was published on the identical day silver traded at $74, down from $121 after experiencing the most violent single-session crash in 46 years of trading history. The United States government observed silver pricing at $74 and concluded the market valuation is broken. The price is artificially suppressed. We need to construct a floor underneath it. Read that statement again slowly. The government of the United States is telling you the current market price of silver reflects artificial suppression, not genuine supply and demand equilibrium. Now this connects directly to intelligence I've shared in previous analysis. I documented China's silver export control implementation. 44 companies receiving licensing authority. Silver reclassified as strategic material under the identical regulatory framework governing rare earth elements. What Vice President Vance is executing through the price floor mechanism represents the Western response to China's export restrictions. China is constraining physical supply availability. The United States is guaranteeing price support. Both policy actions point toward the same conclusion. Silver prices are moving significantly higher. The only remaining variable is determining the magnitude of that move. And if you're questioning whether silver actually appears on the critical minerals designation, let me eliminate all ambiguity. The United States government officially designated silver as a critical mineral through the new Strategic Reserve Project. The Section 232 National Security Investigation concluded that dependence on imported processed critical minerals constitutes a direct threat to national security infrastructure. Silver functions as an irreplaceable component in every advanced weapon system, every solar panel installation, every semiconductor manufacturing process, every piece of military hardware the United States produces. It is definitionally critical to national security and economic stability. Now let me show you what Hecla Mining just disclosed in their financial statements, because these numbers tell you everything you need to understand about the physical silver market operating behind the paper pricing facade. Hecla Mining Company released their fourth quarter and full year results yesterday. Revenue exceeded $1.4 billion, up 53% from the previous fiscal year. Net income reached $321 million. That's 9 times higher than the prior year. 9 times increase in net income over a 12-month period. These represent the strongest financial results in Hecla's entire 135-year corporate history. I've analyzed countless earnings reports across multiple commodity cycles. A 9 times increase in net income is not normal variance within an established industry. That's what happens when an entire market undergoes structural repricing and you control supply-side assets while demand accelerates beyond production capacity. But those headline numbers aren't even the critical data points that reveal what's actually happening in the physical silver market. This is what matters. The average silver price for the fourth quarter of calendar year 2025 was $54.83. That's the benchmark market average. That's what COMEX futures contract said silver was worth according to paper market price discovery. Hecla's average realized silver price in the fourth quarter was $69.28. Let me ensure you're processing that information correctly. The paper market said silver was worth $54.83. Hecla received $69.28 for their physical production. That's a $14.45 premium per ounce, nearly 30% above the average market price. Not in Shanghai, where physical premiums are well documented. Not through some opaque bilateral agreement in a jurisdiction with limited regulatory oversight. In America, from North America's largest silver mining operation, reported to the Securities and Exchange Commission. On the public record, that's not rumor or speculation. That's an audited financial statement filed under penalty of securities fraud. Now, how does a mining company realize a sale price that sits 30% higher than the market average for the identical time period? There are only two plausible explanations. Either Hecla deliberately withheld production from the market and concentrated all sales into late December when prices spiked to short-term peaks, which would indicate they're timing market volatility rather than maintaining steady production sales. That's theoretically possible, but highly unusual for a company of this operational scale and institutional shareholder base. Or industrial silver buyers are bypassing commodity exchanges entirely and negotiating directly with mining operations, paying substantial premiums to secure guaranteed physical supply because they need actual deliverable metal for manufacturing operations and they cannot rely on exchange mechanisms to provide delivery certainty. I believe the evidence overwhelmingly supports the second explanation. And here's why that conclusion is inescapable. We already have documented proof that Samsung Electronics locked up 100% of production output from the La Pria silver mine for a 2-year period through a direct prepayment supply agreement. We already know that London's silver lease rates hit 34.9% in October because financial institutions were desperate to borrow physical silver for delivery obligations. We already know that Shanghai physical silver trades at a 20% premium to paper silver pricing. And now we have North America's largest silver producer reporting a 30% premium on their realized sale price compared to benchmark market pricing. This is not coincidence. This is pattern confirmation. Industrial buyers are routing around commodity exchanges. They're negotiating directly with extraction sources because the exchange system cannot guarantee physical delivery when contracts reach settlement. And when buyers demonstrate willingness to pay that magnitude of premium to secure silver directly from mines, that tells you the real price of silver is not what the ticker displays on your screen. The real price is what someone will actually pay to obtain physical possession. And right now, that price sits far higher than the official market quote. And this connects directly to what I documented in my previous analysis about the Shanghai premium structure. Physical silver in China trading at $99 while COMEX shows $74. Now we have confirmation from the supply side showing the identical pattern operating in North America. The mines are receiving significantly more than the paper market price because the paper market price does not reflect reality. The chief executive called this year transformational for the company. 12 months ago, they were carrying hundreds of millions in debt obligations. Now they're essentially debt-free. Silver accomplished that transformation in one fiscal year. And looking at their forward strategic planning, Hecla is making a move that I consider one of the most significant signals in the entire mining sector right now. They're divesting their gold mining assets for almost $600 million to concentrate exclusively on silver production. Gold is trading at $5,000 per ounce, and they're selling the gold mine. Let me repeat that because the implications are staggering. They are choosing silver over gold when gold is at $5,000. These executives know something. Their guidance for the coming year projects 15 to 16.5 million ounces of silver production, and they're nearly doubling exploration expenditure to $55 million. And their cost structure explains exactly why they're exhibiting this level of confidence. All-in sustaining cost sits at $18.11 per ounce. Realized sale price $69.28. That's a $51 margin on every single ounce produced. 74% profit margin. Their Greens Creek operation in Alaska reported negative cash cost after byproduct credits. Negative cost. They're getting paid to extract silver from the ground. That's how profitable this production environment has become. Now let me show you what the chief executive of APMEX just told his customer base, because this directly impacts anyone who purchases physical silver through retail channels. Ken Lewis, APMEX's CEO, published a letter to customers on February 17th. And I want you to hear the key statement directly. He said shipping times and customer service levels have returned to the fast, reliable standards you expect and deserve. That sounds like positive news on the surface. Shipping normalized. Problem resolved. Operations back to standard capacity. But let me show you what else he disclosed in that same communication. He thanked customers for their patience, understanding, and trust during one of the most extraordinary periods the precious metals market has ever experienced. He stated they faced unprecedented demand, record price volatility, and supply challenges that placed pressure on the entire industry infrastructure. Let me provide context so you understand the magnitude of what he's describing. APMEX is the largest online precious metals dealer in the United States. And for approximately 4 consecutive weeks, they could not ship silver orders within their standard delivery time frames. They added 4 extra business days to every estimated ship date. They reduced their product catalog to 31 core items and could only maintain 21 of those in active inventory. They increased customer service staffing by 25% just to handle incoming volume. And they experienced weekend order volumes that were 7 times higher than normal baseline metrics. This is the largest dealer in the country with decades of operational experience, with massive warehouse infrastructure and direct relationships with minting operations. And they were completely overwhelmed for an entire month. And some of you watching this transmission right now lived through exactly what I'm describing. You placed an order in January and waited weeks for delivery. Some of you may still be waiting on orders from other dealers with less operational capacity. If that doesn't prove to you the physical silver market fractured under demand pressure, I don't know what evidence would be sufficient. Now here's my question. If APMEX is back to normal operational capacity, is it because supply infrastructure expanded to meet demand? Or is it because the 46% price crash scared enough buyers out of the market that demand temporarily collapsed below supply capacity? I believe it's the second explanation, and here's the evidence. The APMEX letter explicitly states many firms across the industry are still working through supply constraints and service challenges. Other dealers remain behind. APMEX caught up while others haven't. And I want you to notice the timing. The crash occurred on January 30th. APMEX says they're back to normal on February 17th. That's 18 days. 18 days for APMEX to clear their order backlog after the crash temporarily killed buying demand. So what happens when silver prices start advancing again? When prices recover toward previous highs? When the next wave of buying pressure hits the retail market? If it took APMEX a full month to catch up after a crash eliminated demand, what happens when demand returns to previous levels or exceeds them? The answer is the same thing that happened before. Shipping delays, inventory shortages, premium expansion, and the cycle initiates all over again. And I want to be absolutely clear about something. The fact that APMEX had to publish this letter at all is the real story. A chief executive does not release a public letter saying, "Please be patient, we cannot ship your silver during normal market conditions." This letter exists because the physical silver market broke for a full month and they're informing customers it's fixed now. But the structural shortage that caused the breakdown hasn't changed. The supply deficit is still running. The inventory is still draining. And the demand is still growing. I also want you to notice the specific language he used to describe this period. One of the most extraordinary periods the precious metals market has ever seen. The chief executive of the largest precious metals dealer in America, a man who has navigated every market cycle for decades. He's calling this the most extraordinary period ever. That's not the language of someone who thinks the volatility is over. That's the language of someone who knows what's coming next and is preparing operations for the second wave. This is the cycle I've been warning about. Prices surge, demand explodes, and dealers can't keep up. Then comes the violent smash. Demand cools temporarily. Backlogs clear. Confidence resets. And just as the market starts to feel stable again, prices begin climbing right back up. Each loop looks similar on the surface, but structurally it gets tighter every time. Inventory shrinks. Deficits deepen. Recovery phases stretch longer. Right now, dealers have finally caught up from the last surge. That tells you something important. Historically, this is the moment just before demand returns. But this time there's less metal available than there was during the previous run. Now layer on the options market. Roughly 35,000 March COMEX silver call options remain in the money. That represents massive potential leverage tied directly to futures contracts. Traditionally, large commercial shorts attempt to pressure price into expiration to force those calls out of profitability. We saw a historic collapse attempt in January. It was aggressive, it was violent, and it still failed to wipe out enough positions. Silver has rebounded sharply since. Every dollar higher pulls more calls back into profit, and that's where the pressure begins building again.